Welcome back to Turning Hard Times into Good Times, and I'm really pleased to have with me for the first time Doug Noland. Well, he actually was on this show when John Rubino hosted it when I was on vacation in Europe last summer. But I've known Doug for quite a while. I've known of him when he was at the Prudent Bear Fund, and always enjoyed his work. He writes an awful lot of material, a lot of very good things in terms of keeping up with what's going on in the markets. In fact, I think if there's any one place you might go to try to keep up with all that's really significant globally in the markets, it would be to his blog that he has at the McIlvanney Wealth Management site, and I think it's the Credit Bubble Bulletin page that you want to download or you want to click onto when you go to the McIlvanney Wealth Management website. And Doug has really been known for his bearishness. He told me before we went on live that he professionally has been a bear. He doesn't find a whole lot to be optimistic about long term, I guess, in terms of the current market or the market condition. And I kind of understand that because Doug is an Austrian school thinker, and those of us who subscribe to the Austrian School of Economics believe that we are headed in the wrong direction by the creation of money and credit out of thin air. It distorts markets unbelievably, and yet it's a narcotic that seems to get the establishment through, keep them high, keep them believing in non-realities, as it were. At least that's the way I see it. Doug, thank you so much for joining me today.
Hi, Jay. Thanks a lot for having me on. And, I'll throw out there, I started my Credit Bubble Bulletin back in 1999, and that's before they were even called blogs. So it's been about 20 years. And when I first started it, I thought, okay, I was convinced there was a bubble, right? We had changed finance to all the securitization and derivatives and the Wall Street finance. I was convinced it was a bubble. And I thought bubble would be in the title maybe for a year or two. And here we are 20 years later, and I've been chronicling this almost every week for 20 years, and bubble's still in the title, unfortunately.
Well, Doug, this is what really is difficult for those of us who believe that you can't create money by printing it. You can't create wealth by printing money, or even less than printing money these days, just creating digits. And what's made it difficult is that it is this long. You would think that the system would have imploded, and it started to on several of occasions, but how have they been able to keep the ball in the air so long?
Yeah, well, to me, it's this great experiment, not only in unfettered finance. And if you think of the way finance used to be, it was mainly bank loans, right, where banks were restricted to capital and reserve requirements, and finance was fairly well contained. And even before that, you had, the gold standard and Bretton Woods. You had these different regimes that restrained finance, but we changed it and had all this non-bank credit creation where there was no restraints whatsoever. And early on, it was clear that this type of finance was very unstable. If you think back, we had the bond market bust in '94, and then Mexico and Southeast Asia booms and busts, and then the global financial system almost came unwound in 1998 with the collapse of Russian long-term capital management.
Yeah.
And, all along, I expected authorities would go in and try to, more regulate, try to contain this type of finance. But instead, we started this experiment in monetary management, where the central banks came in to work to stabilize this unstable finance. And all it did was allow this finance to get bigger and the bubbles to get bigger. And then we saw, the terrible crisis in 2008. And what did they do after that? We didn't learn any lessons from this. Instead, we do, massive QE, zero interest rates, and all of this, not to try to stabilize finance, but to try to reflate finance, try to reflate asset markets and credit generally. And it's just led to what I referred to it back in 2009 as the global government finance bubble. The bubble went global. It went across asset classes. It's basically, the whole system globally. And I hesitate to call it a system because it's not much of a system. But, the whole global financial infrastructure went into this massive bubble. And why it's so dangerous, Jay, is this bubble, it's not in mortgage credit, it's not in speculative credit, it's gone to the heart of money and credit, right? It's in central bank credit, it's in sovereign debt, and that's why I worry about this bubble, because when this bubble bursts, this is I called it the granddaddy of all bubbles. I don't know how they reflate after the next crisis, but anyway, hopefully I'm proven wrong on this.
Well, you would have probably thought that before the previous crisis, though, wouldn't have you, Doug? I mean, I would have thought, after the, we had, you just went through the 2000 .com collapse. Then they, as you say, they didn't try to pull back credit. They didn't try to regulate it or hold it down. They just expanded it. And it's like a narcotic to try to get an addict through the next, to avoid any kind of a decline. Do you think they can do it again? Do you think they can go on? I think, we've had Rickards on this show, and he believes that the only institution that's left the next time will be the IMF, and that will go to some sort of a global credit, a global monetary system. SDRs, I guess.
Yeah, and that's a possibility, but I'm not sure, if Washington, if the U.S. government has an appetite to watch the IMF grow into a multi-trillion-dollar institution, perhaps. And that's another worrying part about the environment today and what this means when this bubble bursts. The last bubble, there were synchronized policy making from the central banks, from governments. Mm-hmm. This is a much different atmosphere as we, and also, I think the only balance sheets that will be big enough to try, because what happens here is when the bubble bursts, you have all this speculative credit, call it the hedge funds, banks, they borrowed money to speculate in securities, and they get in trouble and they have to liquidate. Somebody has to buy them. So I think it'll be the central bank balance sheets. What will be different, though, I think in this next crisis, the central bankers will be seen as part of the problem instead of the solution. They'll, the opinions will be, well, look what central banks have created through QE and all this aggressive stimulus. So I think central banks will probably be more restrained, at least in the early parts of the crisis. So again, I don't see the next reflationary source outside of the central bank balance sheets. And what could really, really cause trouble is if the markets start to protest the aggressive balance sheet growth by the central banks and interest rates start to go up, especially for long-term sovereign debt, treasuries, et cetera, that will really compound the situation, because in the past they've had the freedom to do whatever they want with their balance sheets because the market was cooperating, interest rates were going down, yields were going down. In the next crisis, if yields surprise and don't go down, central banks have a much, much more difficult job ahead of them.
You mentioned a different atmosphere. It most certainly seems to be the case because 2008, 2009, the Chinese stepped in and stimulated in a major way, bought a lot of commodities and things, and helped to reinflate the global economy. This time, and I don't know if it's if you can put the blame all on Donald Trump or not, but certainly there is more of a geopolitical divide, I would suggest, now than there was in 2008, 2009, that might get in the way of this coordination, even if they have the wherewithal, the financial strength to coordinate. Do you see that? Do you see growing geopolitical issues as something to be worried about?
Yeah, absolutely, Jay. And the way I look at these bubbles, these are mechanisms to redistribute and destroy wealth. You don't really see it until the bubble bursts. That's when you realize that wealth is destroyed during the boom. And that's always a problem. And we saw it in this country after the mortgage finance bubble because, a lot of people, lost a lot of money unfairly. They bought homes and, the system was, the bubble period just redistributed wealth from a lot of unsuspecting, innocent folks out there. And Society has paid a price for this. I worry when the global bubble bursts, that will lead to significant geopolitical tension, and we're already seeing it. Right when the pie starts to get smaller, then everybody worries about their size of the pie. I don't expect that we'll be cooperating closely with the Chinese during the next crisis. I fear China has a historic bubble, and I think there are cracks in that bubble today, and I fully anticipate Beijing will blame the U.S. when their bubble bursts, right? They'll blame foreigners, and now the administration has set this up to be a pretty easy scapegoat for Chinese officials. So, yeah, very, very different backdrop than what we saw going into 2008.
Yeah. Well, we have tremendous amounts of gold seemingly being imported into China from all that I read, from the west to the east. We're seeing an alliance between Russia and China. We're seeing the Chinese build up the infrastructure to trade with Asian countries, even with Russia and European countries, India. They're setting up different, both financial infrastructure as well as physical roads, highways, bridges, and so forth. Do you see a very major potential decline in the primacy of the United States as a superpower, as a world power, and might that also have some impact on our currency at some point in time?
Yeah, great questions, and I certainly see there is an obvious move to set up a non-dollar system globally, led by Russia, China, and others. I mean, that's clear. So I think from that standpoint, the dollar will have less international reserve status going forward, just because we'll be in this bipolar world. This bipolar world, I'm not sure how that bipolar world handles a crisis. And I've made the point where we've kind of had an arms race in bubbles, where this bubble finance has led to enormous geopolitical influence in China. And if their bubble bursts, then they'll have waning financial, economic, military power globally. So there's a lot of factors involved here in why these countries want to control their finance, want to get out of the dollar system, to rid themselves of the impact of U.S. policies. And also, I think they see a lot of problems coming, and I think they're trying to batten down the hatches and get ready to stabilize their own systems when the global finance gets in trouble.
I should tell my listeners that I believe, Doug, you have a daily blog, or at least you really sort of scour the planet and have important news items that are posted every day, I believe, and then you do a more comprehensive or a more commentary in your weekly blog. But certainly you follow what goes on all over the world. In Europe, one of the things that I found very interesting was when President Obama was putting together the nuclear deal with Iran, and he was able to get a lot of the European countries, China, India, and other countries to sanction or to boycott or not to trade with Iran to try to put pressure on Iran. He finally gets the deal signed, and the neocons in the United States are trying to keep it from happening. And Vice President Kerry made a speech in which he suggested that if you try to stop this, it's going to be potentially very problematic for the dollar. He said, look, we've got the Iranians to agree to a deal now. The Europeans and other countries have sacrificed far more than the United States has to try to get this deal put through. And now you want to renege on this deal? And he suggested that this would be a threat to the hegemony of the U.S. dollar, the status of the world's reserve currency. And then, of course, what happens is Donald Trump comes along, and he does exactly what he was warning. And now we're seeing the Europeans are very upset about this. They get together with the Chinese and the Russians at the United Nations here about a month ago or so, and they start to contrive and work together to find a way around the use of the U.S. dollar. Any thoughts about how serious this may be, the potential divide between the United States and our closest allies in Europe?
Right, and it gets right back to our own two political parties here in this country that their views of the world are so radically different. So I think the rest of the world now has to adjust and say, okay, every 4 years we can have a radical change in U.S. policy. We can throw out old treaties and bring in new treaties. And I think this just leads to this feeling that the U.S. is not a dependable overseer partner of a global system. Or partner, or you can't have your reserve currency. You can't have the U.S. as the dominant financial player in the world if you don't have any clarity on what their policies will be every 4 years. So unfortunately, I think this is just all symptomatic of the fragmentation of politics here in the U.S. globally, and how it's going to be very difficult to come to a consensus as far as how to approach Iran, how to approach a crisis, how to approach anything, how to approach China. How do you do that today, right? There's just instability of views.
Doug, with 3 minutes left here, what are we to do about all this? I mean, it seems to me the equity markets look like they're coming under pressure now. Do you think this is the start of a very significant bear market? That's the first question. The second one I want to ask you concerns the debt markets. It was the 1970s, and I just saw an article somewhere on Zero Hedge. Someone was talking about the fact that we're starting to see both stocks and bonds go down together a lot of times these days. Do you think we may be nearing the end of confidence in the fiat money system, in the monetary system, at least from a cyclical point of view, and that we could be heading for some very difficult times in the paper assets? And if so, what should investors be doing?
Yeah, again, great questions, Jay. Yeah, my view is this is a multi-decade experiment, a multi-decade bubble that's gone global, and I expect this experiment, unfortunately, to fail, the bubble to fail. I think I've written as much. We now have important cracks in the global bubble. I think the bubble has been pierced. I think over recent weeks now, we've seen what started at the periphery make it to the core, de-risking, deleveraging. So I fear we're at the beginning of a very difficult period. And as you said, in the fiat currency is one way to look at it, but I certainly believe that we could have a crisis of confidence in financial assets generally, globally. We could have a liquidity crisis globally. We could have a crisis of confidence in policy making. So I think it's time to hunker down. I think being very risk averse, I wouldn't, be involved in the stock market. I'd be very cautious with debt. I think it's a great time to pay down debt, and I think it's time to just get mentally prepared that things are going to change. Because for the past, number of years, we've convinced ourselves that everything's great, that central banks have it under control. I don't believe they have it under control at all.
Well, and you were certainly right. We've bounced back on a couple of major problems in the past 2000, 2008, but it may not be so possible the next time. And so with 30 seconds, people should do what? They should get out of debt, stay out of the equity markets, own tangibles, own gold. Yeah.
Absolutely.
Gold?
I didn't speak enough about precious metals and gold, but absolutely, there has to be a place for that in every portfolio today. So far, it hasn't done as well. The dollar's been strong, but gold, definitely.
It will have its day, no doubt about that. And it's mwealthm.com. M as in Mary, wealth, M as in Mary.com. Go there to take advantage of all that Doug Noland writes daily and weekly. Thank you so much for being with us, Doug. It's a pleasure. I hope we can do it again sometime soon.
Great to be on with you, Jay. Thank you.